Today, we're diving into the electric vehicle market, a space currently facing growing skepticism and economic challenges. Growth has slowed, and many middle-class consumers are hesitant to fully embrace EVs, especially as some governments scale back their aggressive electrification targets. One critical issue stands out. Many EV manufacturers, from startups to established automakers, are struggling to achieve profitability. Instead of making money, many are burning through capital at a rapid pace. The industry is flashing warning signs, and in this video, we'll examine 6 clear indicators of the financial stress facing the EV market. Indicator 6. Startups are running on empty. EV startups are in a particularly vulnerable position. Unlike legacy automakers that can rely on strong sales from gasoline and hybrid vehicles, startups have gone all in on electrification. Many are now grappling with the harsh realities of high production costs, ongoing supply chain disruptions, and raw material price volatility. Take Rivian as an example. Despite backing from major investors like Amazon, the company reportedly spends significantly more on producing each vehicle than it earns from sales. Some estimates suggest Rivian's production costs per vehicle can be over twice the average sale price. While Rivian continues to attract investment, other startups are running out of steam. Canoo, for instance, had only $6.8 million in cash as of late 2023, a massive drop from $450 million in 2022. Across the board, EV startups are facing plunging stock prices, declining revenues, and workforce reductions. Even Tesla, while far ahead of its startup peers, has not been immune to market pressures, recently cutting 10% of its global workforce to preserve cash and adapt to changing conditions. Indicator 5. Fisker's future is looking foggy. Fisker is another EV company under serious financial strain. In recent filings, the company raised doubts about its ability to continue operations over the next year. That uncertainty is underscored by poor sales performance and stock price volatility, falling from 75 cents to 40 cents in just 1 week in March 2024. Fisker produced over 10,000 electric SUVs last year, but only managed to deliver around half. One factor complicating its finances is its reliance on third-party manufacturing, such as Magna in Austria, which builds the Fisker Ocean SUV. Despite earning $200 million in revenue in the last quarter of 2023, the company reported a loss of $463.6 million. Fisker has responded by laying off 15% of its workforce, but the long-term outlook remains uncertain. If the company files for bankruptcy, it wouldn't be the first time. It previously filed under its earlier iteration in 2013. Indicator 4. GM revs up hybrids again. General Motors, once committed to a fully electric future, is now pivoting due to slower-than-expected demand and technical challenges with its Ultium battery platform. While GM had aimed to sell 400,000 EVs annually by 2026, its current numbers are far lower, largely bolstered by the now discontinued Chevy Bolt. In response to changing consumer demand and revised federal emission regulations, GM is shifting gears. High-profile EV projects like the Chevy Silverado EV and GMC Sierra EV are being delayed. At the same time, GM is preparing to reintroduce hybrid vehicles, a move encouraged by many of its dealers who see stronger demand for gas-electric models in the current market. Indicator 3. Ford barely escapes electrification overdrive. Ford has also encountered significant headwinds in its EV transition. The company reported over $5 billion in EV-related losses last year, prompting it to pause a $12 billion expansion plan. For every F-150 Lightning sold, Ford lost tens of thousands of dollars. Sluggish sales of both the Lightning and the Mustang Mach-E have left dealers with excess inventory. These challenges, along with ongoing reliability and safety concerns, have pushed Ford to rethink its electrification strategy. It is now focusing more on hybrids and scaling back EV production. Ford dealers, too, are stepping away from expensive electrification programs as the company seeks to stabilize and refocus on profitability. Indicator 2. Market slowdown. Much of the financial strain in the EV market stems from overestimated growth projections. The path to profitability in the EV space depends heavily on reaching certain production and sales volumes, something that's become increasingly difficult. In early 2022, the EV market experienced strong growth, with year-over-year sales increasing by 81%. By the first quarter of 2023, that growth slowed to 46%. Now, in 2024, preliminary data suggests growth has nearly stalled, with Q1 showing just 2.6% year-over-year growth and a 15% decline from the previous quarter. This slowdown is happening despite improved supply chains and record production capacity, creating a disconnect between supply and demand. As a result, EVs are becoming harder to sell, leading manufacturers to offer deep discounts, further cutting into profits and raising concerns about long-term market sustainability. Indicator1 New Regulations. One of the clearest signs of a recalibrated EV strategy in the US is the EPA's updated emissions proposal. Previously, the agency aimed for 2/3 of new car sales to be all electric by 2032. The revised target now calls for just 1/3. This change reflects the market's slower adoption rate, as well as growing financial stress among automakers. It gives traditional car makers more leeway to continue selling gasoline-powered vehicles, including highly profitable pickup trucks, without needing immediate powertrain overhauls. The decision is partly influenced by lobbying from automakers and labor groups, like the UAW, who have expressed concerns over job security and economic stability amid the EV transition. With these regulatory adjustments, legacy automakers such as GM and Ford are expected to maintain strong earnings from internal combustion vehicles while reassessing their EV timelines. Thanks for tuning in to Quiz Pop. Don't forget to subscribe and hit the notification bell to stay updated with the latest news and insights from the automotive world. Until